It's been a remarkable week as far as oil is concerned, really grabbing the headlines as WTI crude May contract dipped into negative territory for the first time ever, falling as low as $40 a barrel. And that has dragged the rest of the oil market with it. And while the May contract has since stopped trading as of yesterday, the June contract is already coming under severe pressure. The same applies again to Brent crude. There's been a lot of attention on the oil space over recent weeks. The combination of the demand destruction that's been caused by the coronavirus, planes being grounded, people being locked down, the demand for oil has obviously been far smaller than what we are typically used to. The estimate suggests it could be around 30 million barrels a day that's been wiped off demand. Now, this obviously far exceeds the supply cuts that were agreed by OPEC and its allies only a week or two ago. They agreed to cut production by 9.7 million barrels a day. Now, it was expected at the time that private output would decline as a result of the movement in prices, which would add to this to really close the gap in terms of the difference between the supply and demand side, which has crushed prices already heading into what has been quite an explosive week. But like I say, there has been a huge amount of attention on it. And as you can see from the chart on your screen now, we are currently seeing oil trading around falling as low as the $12 a barrel mark. Now, I should state that this price is derived based on futures prices. It doesn't necessarily reflect the near-term contract that you have seen in the news recently. So while the WTI May contract fell as low as minus $40 a barrel, that was not reflected in this, which was, like I say, which is derived from futures pricing. So we've fallen as low as $12 a barrel as far as WTI is concerned here, and it's continuing to look extremely vulnerable to the downside here. The supply-demand dynamics have not eased in any way, shape, or form. You would expect over the next few weeks we may see private production fall. We may see Donald Trump strike a deal with the oil industry that keeps oil in the ground and reduces the production numbers, and that could alleviate some of the pressures. But right now, the panic that ensued around that May contract is likely to apply further near-term pressure to those oil prices, which could keep it under pressure near these multi-decade lows that we're seeing on this particular screen right now, and also potentially even into single digits. So oil prices are going to continue to be one to watch, but I think there's also a few other things that we need to watch as part of this. One is going to be overall market sentiment, which may provide a little bit of support in a few weeks, over the next few weeks, should we see equity markets rebound. The other thing as well is the data that we do get from oil. So that is the EIA oil inventories, the API oil inventories, which are released a day earlier on Tuesday. The Baker Hughes oil rig count, that's released on Friday. That shows the number of oil rigs that are currently active in the US, and that has been plunging over the last few weeks. And also general oil production from the US. These figures are released weekly, and as we've seen from these figures, oil production fell around 800,000 barrels a day from 13.1 million to 12.3 million over the course of the last month. And I would expect this to fall sharply further. While the US isn't exactly part of the OPEC Plus agreement from a couple of weeks ago, there must have been assurances from the US side that production was already falling and was going to fall further in order to get Russia on board. And I would expect to see that reflected in these figures. But until we see those digits, those details reflected, I expect the panic around those near-term contracts to continue to weigh on oil prices for the at least for the next couple of weeks, which means there's going to be a lot more scrutiny and a lot more volatility.